After last week's payroll report in the US, everyone is now talking interest rate cuts and heightened recession risk. Suddenly, they're everywhere. We went from strong and resilient to uh-oh in a hurry. And it's not because of the headline payroll number. More and more people are realizing that one is faulty and unreliable. Instead, the unemployment rate has grabbed the world's attention. That's because, as I talked about in a recent video, unemployment is rising throughout much of the world and a majority of the developed world. The United States, as I said in it, is not immune. So we're hearing increasing references and expectations for lower interest rates along with that higher unemployment. One major bank strategist team just came out with expectations for 8 consecutive rate cuts out of the Fed starting in September. Basically, the recession scenario is becoming much more difficult to laugh off under the cover of a strong and resilient labor market that hardly anyone believes anymore. That's why you're probably hearing an explosion of references to something called the Sahm Rule. The unemployment rate has moved high enough already, it is triggering all the unnecessarily complicated economistic measures into flashing major warnings too. And there's another potential major warning. This one's starting to develop in the Treasury market. A possible uninversion bull steepening signal from right in the middle of the curve. And we'll talk about that one here too. Against all of that, Jay Powell is right now in front of Congress telling the politicians he's got it all covered. The soft landing is in the bag, nothing more than just a little slowdown. Yet even he too is starting to hedge his bets a little and sounding a little bit more dovish than he had in the past. He'll still say strong and resilient, but underneath his breath you can hear the hedging going on.
In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June.
And it's at a low level of 4.1% historically speaking, but that's not important, and he knows it. It's not the level that matters here. It's not the level that's gotten everyone's attention. It is the move from the low last year. It had been much lower, 3.4% last April, which was a 50-plus year low that everyone talked about incessantly. And the unemployment rate is the best view of the labor market. It discounts all of those who fall out of the labor force. So if the most charitable view of the labor market suddenly becomes a lot less charitable, that's something to pay attention to. And Powell is indeed doing that, as he also told Congress.
At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment.
Setting aside the idea that interest rates have any power to influence any of these things, what he's basically saying is, yeah, we're getting a little uncomfortable because we're seeing the softening in the labor market, and we are indeed beginning to wonder if we've got this consumer price thing under control, or we're confident about it, at least according to our definition of how things go. And maybe we need to start paying more and more attention to what's happening over here with that unemployment rate. Yes, it's low, and I'm going to say it's low because that makes it sound benign, but it has moved up substantially to the point that everyone is now talking about unemployment. And as I mentioned before, in the context of rising unemployment around the world, this is not something that people can just casually dismiss any longer, as they have been doing all this time, really going back to September and October when everything really started to change. But to get behind all of this unnecessary noise, or what passes for mainstream financial journalism, that's why Eurodollar University offers memberships and subscriptions. And they are now on sale at some of the lowest prices we've ever offered since our launch a couple years ago. We have tons of videos on everything from the basics of money and financial concepts, even the basics of QE and QT that you won't get anywhere else. The history of money, and especially ledger money, the Eurodollar. We have a daily deep dive to dive far deeper behind all the topics that I bring up here on YouTube. Also a daily briefing to keep you up to date on everything that's happening in money and macro. As I said, anniversary sale prices for a limited time. Check it all out at our website, Eurodollar.University. The Sahm Rule. Suddenly we get mainstream articles all over the place. Bloomberg, CNBC, Reuters, all of them talking about the Sahm Rule. In fact, CNBC, as I'll talk about in just a moment, got Claudia Sahm on the channel to talk about what's happening in the labor market. What is the Sahm Rule? It was created by an economist by the name of Claudia Sahm in 2019, and basically it's a simple mathematical creation. When the 3-month average of the unemployment rate is half a percentage point above its 12-month low, the economy is in recession. It is basically a coincident recession signal. And as of the latest month, the June numbers that just came out last Friday, the Sahm calculation was 0.43. So just 0.7 of a percentage point below what would trigger this Sahm Rule ruling that we're in a recession. But we've been in a recession, at least in the danger zone, at least according to this one mathematical calculation, going back to last October. It hasn't moved above the half percentage point that usually is the triggered threshold, or what everybody accepts as the trigger threshold. But being just below it and moving, creeping a little bit higher along the way, that's what's got everyone's attention. Everyone is starting to see that the unemployment rate is signaling something substantial here. That's not strong and resilient. The labor market may actually have cracked. And this is not a forecasting tool either, by the way. This is, as I said, a coincident indicator. It tells you once recession has already begun, not that one is coming, that it has already started. If you go back in time using the Sahm Rule numbers and the calculations there, by the time you get half a percentage point on a 3-month average that's above its 12-month low, you're deep into recession already. Go back to the Great Not Recession. The Sahm Rule didn't get triggered half a percentage point until April of 2008, already 5 months into recession. The NBR would later, in December 2008, date the start of the recession in December 2007. So by the time the Sahm Rule got to the half percentage point above the 12-month low on the average 3-month basis, we're already past Bear Stearns, and the first half of the Great Not Recession was well underway by then. The cycle before that, in May 2001, the Sahm Rule calculation, or the Sahm number, was 0.47, so just shy of the rule, and it would trigger it the following month in June of 2001. But the dot-com recession started, according to the NBER, in March. So it was 3 months into the dot-com recession before we finally got the confirmation from Claudia Sahm's number. November 1990, you got a trigger then, but that was already several months into the recession, which began in July. And a lot of recessions begin in the summertime. So November 1990, by the time you get the half percentage point trigger in the Sahm number, already several months into recession. So economists around Wall Street are paying attention to the unemployment rate. They're using these various numbers, knowing that there is something substantial going on here. But we don't really need the Sahm Rule. We just need to look at the unemployment rate itself. When you look at the unemployment rate, the fact that it's moved up 0.7 of a percentage point since the low is all you really need. That's a solid recession signal already. But with everybody talking about the unemployment rate and, of course, now the Sahm Rule, CNBC decided they were going to interview Claudia Sahm, because why not? What she said was, or what the article said was, as the jobless level has ticked up in recent months, it's actually gone up every month for the last 4 months. It's up 0.4 of a percentage point since January. The Sahm Rule has generated increasing talk on Wall Street, it's everywhere, that what has been a strong labor market, it was never really strong, is showing cracks and pointing to potential trouble ahead. Well, if the Sahm Rule triggers, it's not ahead, it's already happening. That in turn has generated speculation over when the Fed finally will start reducing interest rates. The markets have been doing that. Sahm, who's now the chief economist at New Century Advisors, said the central bank is taking a big risk by not moving now with gradual cuts. By not taking action, the Fed risks the Sahm Rule kicking in, and with it, a recession that potentially could force policymakers to take more drastic action. Who cares about the Fed? It's about the economy. And it's gotten to the point where, especially with the unemployment rate punctuating all of this weakness, even mainstream economists and strategists at the biggest banks and brokers are throwing in the towel and saying, we see the Fed cutting rates very sharply in recognition of what's happening in the economy. Again, it's not, rate cuts aren't going to help. They're just the Fed admitting and confessing to the weakness that they also now agree and acknowledge, and they're acknowledging it by lowering short-term interest rates. The economy has cooled off from its heady pace in 2023, with inflation resuming its slowdown after some unexpected stickiness, said Citi analysts led by chief U.S. economist Andrew Hollenhorst. But the Institute for Supply Management Service Sector Gauge, which abruptly reversed into negative territory, wasn't abrupt, it's been coming for months, and the monthly jobs report, which showed unemployment rising to 4.1%, have raised the risk of a sharper weakening of economic activity and a faster pace of rate cuts, they added. And this being Citi's strategists led by their chief U.S. economist. In fact, they have now forecast that the Federal Reserve is going to be forced into 8 consecutive quarter-point rate cuts beginning in September. And they're going to be forced into that because, by their reading, the U.S. economy is not strong and resilient. Now, Hollenhorst and Citigroup, they also mentioned the decline in temp jobs that I highlighted from the payroll report. That's a clear cyclical signal too, suggesting substantial deterioration. And of course, he brought up the Sahm Rule because everybody's bringing up the same thing nowadays. Continuing, he said on an appearance on Bloomberg TV, most economic activity is going to be more responsive to a 5-year yield, the 10-year yield. It's not really about the overnight policy rate. So there really are questions about how much can you transmit that stimulative effect of lower policy rates. And it's not stimulative at all. And he realizes that, which is why he's focused on the 5 and 10-year part of the Treasury curve, because there's more informational content in that, as well as any possible effect and impact on the economy than up at the front end of the curve where the Fed is. What he's basically saying is the Fed's going to panic into rate cuts because they see weakness that is far beyond their own understanding and thresholds for tolerating that weakness. And the unemployment rate is a big one. It's one you can't really ignore because, as I said before, it is the most charitable view of the labor market. And suddenly it's not very kind to what's happening. But speaking about the 5-year and 10-year part of the curve, which is a part of the curve that I watch all the time, is sort of an initial indication about conditions in the general economy, the monetary system, whatever the case may be. The 5-year, 10-year spread, basically the entire financial world lives and operates in that part of the curve. You've got mortgages and everything else, 5 to 10 years. Now, it isn't conclusive, but if you're watching the yield curve and you see big changes happening in that 5 to 10-year space, that's something you need to stand up and pay attention to. And the 5 to 10-year spread has been inverted on and off over the last couple of years. It's been more often inverted than not. And when it uninverts, it has signaled big changes in the bond market. It uninverted in a substantial way back in May of last year at the tail end of the banking crisis, just after First Republic failed, which was sort of a final last hurrah of that part of the banking crisis and that part of the yield curve history. It uninverted again more sharply, more bull steepening in October, even before we got to the big bond rally. The 5-year, 10-year spread uninverted, signaling that there was changes underway in the Treasury market. Of course, the bond rally actually happened at that time too. So as you got the 5-year, 10-year uninverted last year, we got the big rally in bonds. Maybe the recession began, half a recession at the very least, as we see they're all over the household survey and the unemployment rate. The 5-year, 10-year spread flipped positive again, uninverted, bull steepening over the last several weeks, to the point that it's made a pretty noticeable move, and as of yesterday got up to about 6 basis points in a positive spread, uninverting, bull steepening potentially there. This is something we see as maybe a first step toward the full curve moving in that direction, the bull steepening case in the curve. It's not, again, the 5-year, 10-year spread is just an initial signal. We would like to see it make a more decisive move as it does preceding recessions, such as in 2007. You got a really big uninversion, bull steepening in the 5-year, 10-year spread and other spreads too, like the 2-year, 10-year. In July of 2007, heading into the crisis in August. Same thing also if you go back to 2000, just before the dot-com recession. You see the 5-year, 10-year spread, one of the first parts of the curve to uninvert in the bull steepening case, as early as November 2000. In fact, that was a couple months before Alan Greenspan started cutting rates in January of 2001. And it was about 4 months before the recession began. So you see a pretty substantial move in the 5-year, 10-year spread, uninverting and bull steepening in 2001 before the recession there as well. But as I keep pointing out, it's the 5-year, 10-year spread by itself is not conclusive. And right now, the 5-year, 10-year spread in uninversion that we're seeing, while consistent with a bull steepening case, it's just a nascent move. It's not anything that is conclusive and decisive, at least not yet. But going along in the context of everything else that we're talking here, that's something that we need to pay attention to because it could potentially point to the full bull steepening case, which would be a timing signal as well as confirmation signal. So now we got everybody talking about the unemployment rate. And again, the unemployment rate is the most charitable view of the labor market. And if the most charitable view of the labor market is suddenly less kind about the labor market, that's something that you need to pay attention to. And Wall Street strategists are now paying full attention to it, as is Mr. Powell, as he kind of admitted under his breath in testimony before Congress. They see the unemployment rate and suddenly the strong and resilience in the labor market doesn't fly, doesn't wash anymore. The labor market and the U.S. economy are far weaker than people have been giving it credit because they have been led to believe that we dismiss all of these warning signs along the way because Jay Powell said strong and resilient. Well, the unemployment rate is one signal that it's become impossible to completely set aside and ignore. I've said all along that this was a cycle. As a cycle, this was always how it was going to end. While the U.S. watched economy after economy around the world tilt into recession, it was only a matter of time before it tipped into one too. After all, I believe we've been halfway to a recession since last September and October, and maybe got 3/4 of the way there over the last couple months as the unemployment rate rose, continued claims spiked, companies complained about their customers having no money, to the point that even the cheerleaders on Wall Street are changing their tune and embracing timing signals like the Sahm Rule. And while they do, we're going to keep our eye on other timing signals too across the yield curve. Because the economy is not strong and resilient, and more people are starting to realize it. I went over all the gory details behind the ISM Services Index and its solidly recessionary signals in the video linked below. As always, thank you very much for joining me. Check out Eurodollar University's anniversary sale. And if you are a new member or an existing member, I can't thank you enough. So thank you to all you members and subscribers, and until next time, take care.